I don't know if there's a more interesting quarter in recent memory besides, maybe the depths of COVID. So a lot to dissect with you all, and thank you all again for hopping on. So our first victim is Sandy here. Sandy is a phenomenal teacher at the University of Texas, where he teaches MBA and undergrad students finance and the headline course, Money and Capital Markets and others. He was my professor when I went to UT forever ago, but he is also a fairly prolific speaker and gives all kinds of talks. For usually he gets paid. And I was joking before, and he is not getting paid for this one. So it's more or less honest. So you be the judge. But Sandy, do you want to kick us off and just talk for a few minutes about the things you're seeing here in this wild first quarter? And
Sure.
I know you have some slides, so let me see if I can tee those up for you. Okay, go ahead,
All
sir.
right.
Take it away.
Thanks, Sam. Thanks for having me here. This is the great thing about being a teacher. I just pulled a bunch of slides from yesterday's class. So I'm going to talk about four things that I'm thinking about. First, we said we were going to talk about the quarter, and it obviously a great quarter for stocks, but particularly for tech stocks. And hard to know why that is. Maybe it's lower interest rates. Maybe it's the fact that these were the stocks that did the worst last year, and there's a bounce back effect. I just saw something this morning showing a chart showing that the 10% of stocks that did the worst last year, 10 were like the 10% best this year. That sort of thing. Maybe it's a recession bet. That ultimately growth stocks actually tend to do better in recession than value stocks. Value stocks are the riskiest stocks, the stocks that could go away. But regardless, that's what you see. It's really a large cap tech. What you're seeing in this slide is you're seeing that the Nasdaq 100 is way up. This was just for the last month. But if you look at the equal weighted, where each stock was just 1% of the portfolio, didn't do nearly as well. I think that most all the gains in market cap over this quarter came from about 20 stocks in the Nasdaq. So you really sort of have to be in the large ones. I saw an interesting stat this morning that said if you look at the last 11 months, even with all the uncertainty, everything that's been going on, and all the extremist calls for a big drop or a big increase, what we saw was that the S&P 500 was within 5% of 4,000 on 81% of the trading days of the last 11 months. That actually surprised me. I think the big concern that we have going forward are earnings. And in particular, I think it's the fact that we haven't revised down the end of the year earnings, which is inconsistent with a slowdown in the economy, if that's what you believe. This is my favorite chart. I mean, just basically showing we're predicting the economy to slow and earnings to go up. And that's a great world if we could live in it. Second thing I'd point out is just interest rates. Obviously, interest rates dropping significantly. Particularly the 2-year, which is just pricing in that the Fed is going to lower the Fed funds rate significantly. The market's pricing in that we're going to be taking the Fed funds rate down to 4.25% to 4.5%. Right now we're at 4.75 to 5%, and the Fed's saying they're going to raise rates. Cleveland Fed President Mester spoke last night. Said the same thing, reiterated that. I think the yield curve obviously has been inverted. One of the things that people don't realize is the yield curve normally or usually normalizes by time the recession starts. We start to see things are getting bad. The Fed starts lowering rates. The short end goes down, and the 10 years is higher. So it looks with the 2 and the 10 like we're on our way to that. I think one of the other things that's really interesting is that when you think about the Fed funds rate right now, in real terms, when you strip out inflation, it's about at zero if you strip out core PCE. We think that the real neutral rate is around 0.5%. And so, policy is still accommodative if it's below the neutral rate. So I think obviously inflation could come down and that could lift up our real Fed funds rate. But I just think that's a significant issue. We got the JOLTS report yesterday. We had fewer job vacancies, went under 10 million, so significant drop in the number of vacancies per unemployed person. Still high, but the Fed's watching that, and I think that's a positive sign. You tend, what we see, and I don't have any slides on this, but it seems like the market is switching to worrying about growth rather than inflation. We got that OPEC news on Sunday. Didn't really hurt the market. If we were worried about inflation, that might have. And so we're not seeing that. We've seen some Atlanta Fed wage inflation data that basically showed the amount of premium wage switchers are getting is dropping relative to people who are staying. That's also a positive sign, showing that employees don't have as much power right now. Um, the I think the final thing I'll just talk about is, obviously, everyone knows that we've got money leaving the banks, particularly the small banks, is really what's happening, and often going into the too big to fail banks. The money's going also into the money market funds, which from there is going into the Fed's reverse repo facility. I think the big thing that everyone's worried about right now are the office spaces. You're seeing very high vacancy rates in the largest 50 cities. You're seeing it really all over the country. When you've got less vacancy, you've got higher interest rates, and you're going to have tighter credit, we think. And the fact that it's the regional banks that do all this lending. It's been a huge increase over the last 10 years or so, possibly because of some of the regulatory issues. But the bottom line is, if they've got deposits going out and they're going to have tighter lending standards, there are going to be issues. I think the other thing that we have to watch are apartment buildings. I think that they've had a significant drop in price, and I think that you're starting to see some weakness there. You've got some recent purchasers who have variable rate loans. You're not seeing the growth in rents, and so I think those are all the concerns that I have. So there's my 7 minutes to tee us off.
All right. Thank you so much, Sandy. Appreciate it. I'll say the thing that I think is probably most interesting about this group here is everybody has front row seats to the show here, of the markets, but kind of in a different perspective of it. So Neil Wolfson is next on our hit list here, and comes from a background as came through the ranks at KPMG and ran their investment consulting practice as national partner in charge before going on to be the president and chief investment officer of Wilmington Trust, a $40 billion manager, and then worked as a family office runner, and then now as an independent investor in fintechs and a director. And thank the Lord, an investor here at Inventure. So Neil, thank you so much for hopping in. So from your perspective, the different seat at the show here, what are you seeing out there this quarter?
So thanks, Sam. I think it's useful to take a step back and see, how did we get here? And if you look at what happened, the central banks around the world, our Fed included, flushed the system with money. And when COVID hit, they did even more. And you added in all the fiscal stimulus that we and other countries around the world were mailing out checks as fast as we could print them. And what happened? You had inflation. The minute the economy opened up, you had inflation. That money had to go somewhere. And people started spending it. Businesses started spending it. And so it naturally led to inflation. The Fed got it completely wrong, kept saying it was transitory, wishful thinking on their part. It turned out not to be transitory, and they looked bad. And so what did they do? They rushed in to raise rates. The only thing that they can do is raise short-term rates. The only thing directly they can do to slow down the economic growth and to slow down inflation. And so what did they do? They raised rates dramatically. We had 4 meetings in a row of 75 basis points, 300 basis points in 4 meetings. It's unheard of. And so what the effect of that will probably be a recession. And we're starting to see signs of it. Generally, when the Fed is aggressively raising rates, they're doing it to slow down the economy. The thought process that they'd be able to thread the needle and get a soft landing and be able to exactly stop at the right point It is very difficult, rarely done in real life. Generally, they overshoot. I was glad to see them go to 25 because they've slowed down. Basically, they're driving down the highway looking for an exit. They have no idea where that exit is. And they were driving 100 miles an hour. And now they're driving at 40 miles an hour and they'll have a better chance of spotting the exit. The problem is they're using backwards looking data. So everything that's cited, every economic statistic that they look at, whether it's inflation, whether it's unemployment, whether it's GDP, you name it, it's all backwards looking and there's all a lag. And so it's very difficult for them to spot it. And then you compound it with interest rate increases take 6 to 18 months to be felt in the economy, fully felt. So interest rate increases that they are making now are not going to be felt for a couple of quarters. So their ability to navigate that and to understand the impact of that and to be able to stop before that impact has been felt in the economy is something that I think is very hard to do and will not happen because they're focused on inflation. And while inflation has been coming down, it would naturally come down. There are a lot of forces that will drive it down, including a slowing of the economy, including raising rates. In and of itself, adds a cost of credit, will slow down the economy and cause inflation to come down. It hasn't come down anywhere near their rate. They want 2%. We're nowhere near. There is not a print that is even close to 2% or anticipated to be close to 2%. And so I think the prognostication that the Fed is now going to start cutting rates to stimulate the economy, I think is totally wrong. I mean, Jay Powell has been pretty clear about it in every speech that rates will stay elevated for an extended period of time until there's evidence that inflation has subsided. There's no evidence. And an extended period of time is not a next meeting. And so what I think is going to likely happen is the Fed will trigger a recession. Most recessions are caused by the Fed, and they're predated by an inverted yield curve. The inverted yield curve obviously had another major impact. You had banks, some banks, that decided that they would buy treasuries. The Fed encouraged them to buy treasuries with their excess reserves, but they went long. And the problem is deposits are short dated. They're demand deposits. You can get the money out at any point in time. If you go and take that capital and then invest long term, in this case in long term treasuries, problem is if rates go up, the value of those treasuries go down. And there's an accounting convention that the banks are allowed to use where if they say something is purchased to hold to maturity, then they don't have to mark to market. And so that's what they were doing. So it didn't appear to be too bad when rates were going up, but it was. And the minute they had to liquidate those to cover the outflow of deposits, the run on the bank, if you will, they didn't have the capital to do it. And that's the issue with Silicon Valley Bank. Now, there are a lot of other problems. Silicon Valley Bank was somewhat unique. 80 to 90% of their deposits were uninsured. They were going after tech companies in a very aggressive way. And they had tremendous amounts of capital there. Those tech companies are having problems. So they're pulling capital also. So there were a lot of things that happened at once, and they invested a lot in those tech companies. They lent them money and so on. And those companies have been marked down, and some of them are really struggling. So that's another factor that impacted them. So I'm not saying there's another bank that's exactly the same, but there are other smaller banks that have that problem. So where has been the rush to go? It's been into the large banks. I saw a stat recently, 50% of the capital that came out of Silicon Valley Bank went to JP Morgan, not surprisingly. And so what do we see right now? What do I see? I see continued volatility in the markets. I think there'll be a great buying opportunity eventually for equities and a time to go longer in debt, but I don't think we're there yet.
The great and powerful Neil Wolfson. Thank you so much. Appreciate it, sir. A lot to dig into on that one. Before we turn it over to Q&A, and thanks for folks recently joining. Appreciate you all being here. I want to go next to the wonderful Gene Podsiadlo. Good to see you, sir. As a way of a quick background, I met Gene here at Nth Venture. He is probably one of the more interesting folks that you will see ever advising a fund. Cut his teeth at Citi. Then he spent a decade at Warburg Pincus, ultimately as a president of Pincus Fund. And then 17 years, most of that on the board of directors at Wasatch, one of the largest private equity firms out there. And now doing some very interesting things, which I'm sure he may talk a little bit about at Clearbook as a incoming executive vice president. So, Gene, thank you very much, sir. Take it away.
Great. Thanks, Sam. And thanks, everyone, for being here. I just jotted a few notes. Really interesting commentary on the public markets and interest rates. But I thought I'd give you a little snapshot of what I'm seeing in the venture capital private equity world. I am working again full time in that space. It's remarkable to me how quickly the private fundraising capability for startup companies has shifted, at least in terms of the way venture capitalists are looking at potential investments. The most obvious startup shift, and by startup I'm talking about seed to Series A companies, but particularly for seed companies, which have always been, for all the obvious reasons, the riskiest part of the risk curve in terms of a new company. Many times they're still in pre-revenue. Certainly, at best, they have revenue but no earnings. But the shift that's occurred is, where total addressable market and, revenue projections and everything else that people used to look at. The shift now is seeking scalability, but with high margin. And in many cases, they're looking for companies that are a little beyond the seed stage. So long story short, right now, it is very difficult to raise venture capital for raw startups. Unless it's something that's truly remarkable, and I'll talk a little bit about AI, something where there's a technology that clearly has scalability and user adoption that's so rapid it probably warrants taking the risk on a startup company. The rest of the kinds of companies that were getting capital a year ago, even during COVID and certainly before COVID, is really difficult. I get tons of LinkedIn messages every day from people mostly looking for startup capital, and it's very difficult. I think even angel investors have shifted their focus to want to probably go a little bit later stage, see a little more evidence of traction, product market fit, whatever acronym or cliche you want to use. They're looking for that. I was helping a company, you could look it up, called Groomit. I think the website's groomit.me. A couple of years ago, it's actually a custom tech-enabled dog grooming service, and led by a really hard-driving CEO who just refuses to give up. And I brought them around to a couple startup VCs and even angel groups. And they just were not interested in something that was as pedestrian as that business, despite the fact that the gross margins were in the 50 to 60% range. And despite the fact that every new market that they entered, city by city, they were seeing success. By contrast, now, if you go to their website, they're doing great. And I suspect, I haven't talked to them in a while, I suspect that they're probably now getting inbound calls because they have a profitable business. They turned profitable, I think, a year or two ago. They're running several $1 million a year in revenue, and they clearly have an expansion formula that maintains all those aspects. So anyway, that's just one example of a pedestrian business now that I think is more valued by private investors than they were even 1 year ago, 2 years ago. I'm working now with, it's not announced yet, but a large industrial company where we'll be launching a series of venture capital funds. And the other thing that I've noticed that I think kind of intersects with my two prior colleagues' comments, in terms of raising capital, same sort of effect. Institutional investors, including everything from sovereign wealth funds to ultra high net worth family offices, they're looking for generally post seed stage companies. They're willing to invest in A or B round companies, but again, seed stage is of less interest to them. Again, unless it has some really remarkable, generally technology aspects to it. What's interesting to me, despite all the interest rate talk, recession talk, SVB, what's interesting to me is what I'm hearing from some of these large institutions is they want nothing to do with public equity markets. They fear some other shoes to drop in the banking sector around the world. They fear, and this is where possibly this time it's different, even if the Fed were to start to ease off the brakes with higher interest rates by staying put for a while, they fear the tail risks in the world. The obvious one being the Ukraine-Russian war. They fear and are watching very closely what's happening with some of the deals being cut between China and various countries, whether it's Saudi Arabia or some of the Latin and South American countries. There's really a fear about that. And then, of course, there's uncertainty about the upcoming presidential elections in the United States and what's going to happen there. So essentially, for those of you who know how private equity works, there are going to be large write-downs this quarter just ended. There's always a lag. I occasionally hear people misunderstand that, well, private equity, outperformed last quarter. It's like, well, no, there's a quarter lag. So you can't. You're comparing apples to oranges if you try to base it on the same time frame. But so there's no question that public equity tech wreck will be felt by a lot of private equity funds and venture capital funds. But on the other hand, I think what the institutions are saying is they want a more curated and carefully analyzed set of investments, hopefully with some de-risking. In the case of the situation I'm looking at, the de-risking element is there's going to be a large industrial company sort of backing hand in hand the portfolio companies that we select. So that's what I've seen there. The last comment I would make is I thought it was, and Jamie Dimon made this point, I believe, in his annual letter, that he doesn't think the banking crisis is over yet. I thought it was a very interesting and not a very helpful thing that Janet Yellen actually seemed to be raising the the idea that there could possibly be issues with money market funds, which I find kind of preposterous. Some of you may know that there were quite a number of changes to money market funds after the reserve fund, a well-known, venerable money market fund, ran into trouble with, among other things, Lehman Brothers commercial paper. Treasury money market funds themselves, in my view, are among the safest investment right now, and they are yielding a lot. But my point about Janet Yellen's comment was, you've probably heard of the phrase "talking your book." By raising the prospect that maybe there was an issue with money market funds, my thought was that she was trying to potentially introduce doubt among retail investors and institutions about moving their money from bank deposits to money market funds. Because you've probably all read this. That's essentially been the go-to exit repository when someone leaves a bank. They're generally going to either T-bills and short-term paper directly, or they're going to Treasury money market funds. You can see the Vanguard and Schwab and Fidelity money market funds, seeing huge inflows. So the fact that Janet Yellen would be introducing the idea that maybe there's an issue with money market funds, my thought was, does she know something we don't know about other banks that may be having issues with deposit runoff? Ones that have not been publicized. So I tend to agree with some of these institutional investors and with some of the prior commentary. I think we're going to see a lot of volatility in the public equity markets. And I think the heyday of easy venture capital raising is over for a number of years.
Gene, thank you. That's so insightful. There's a lot I want to unpack on the move to the money market funds and AI, et cetera. Before we do that, the latest and greatest, Jay Heller, the man who almost needs no introduction. So Jay has a unique and interesting spot sitting there in NASDAQ as the head of capital markets. He's been there, Jay, now 12?
15 years.
15 years at NASDAQ. Before that, I was a trader. I've done all kinds of interesting stuff on Wall Street, but now, and basically, it was the Facebook IPO, I think, as Jay was incoming. Now, as head of capital markets, I can kind of let you explain what that is and some of the exposure you get there. But let's talk capital markets. So take it away, Jay.
Great. Well, thanks, Sam. And obviously, it's such a pleasure, to be on the panel with everybody else. I will have to say, though, I got to get a set of glasses like Sandy. I mean, God, you look so distinguished with those. And until I get them, I can still see good, but boy, you look great. So I'm going to take a little bit of a different spin. I'm going to tell you where we've been from a capital market formation to where we are now. And then ultimately, some thoughts. I think the biggest thing out there is really, for the most part, high level, is the uncertainty, right? Whether it's, Yellen or Powell, what's the Fed going to do? Are they done? Are they not done? Nobody knows. You look at the futures market, you look at, as Neil was saying before, the unprecedented rate in which the Fed has raised, and to Sandy's point, what tech has done, in the first quarter, for the most part, even if you just look at the NASDAQ 100, you would think we're closer to the end than we are to the beginning, but ultimately we just don't know. So let's kind of put it into perspective. In 2021, we had, just at the exchange, and I'll talk in specifics for NASDAQ because I have the data and it's near and dear to my heart. We had a phenomenal year. When you talk about capital formation, we had over 750 new listings just via IPOs. And so we're not even talking about spin-outs or M&A transactions and those that chose to do deals with SPACs. But from a high level, 751 IPOs that raised primary capital of over $180 billion. That's incredible. still in the midst of the pandemic. Now, you started to see the wheels come off a little bit towards the end, of 2021, and boy, 2022, what a fall off. We still had 161 new listings via the IPO market. We had 74 SPACs. We had 87 operating companies. But there was definitely a change and a shift in dichotomy of the type of companies listing. And that's okay, because again, the capital markets are for everybody. Large or small, everybody should have an opportunity to raise capital, grow their business, further expansion, hire employees, which is good for the economy as a whole. In 2022, though, those 161 companies raised a total of 15 billion. So now we've fallen from 180 billion to down to 15 billion. Here we are, end of the first quarter. I'm going to include today. We had a new listing today on the exchange. And so we sit just past the first quarter. We're at 42 new listings on the exchange, primarily comprised of operating companies, running at a similar run rate to 2022. But the capital raise so far year to date has been probably around 3 billion or less. And so we're talking about an annual run rate of somewhere around $12 million. So from 180 to 15 to 12. But, and I would say this is a big but, I am optimistic. And so it's not all doom and gloom. There will always be great companies that can raise capital in any type of environment. Now, I'm going to spend my time more so than Neil and Gene in the VC landscape for companies that are getting closer to being a public-oriented company. And I will tell you that from the standpoint of who's thinking about it and at least having conversations, the pipeline has never been deeper. That I can assure you. There's over 200 companies that are currently on file, just with NASDAQ language, that are at least thinking about going public at some point in time. And they're staying current. The difference is, as opposed to 2021, and even for the most part, the beginning half of 2022, it's window shopping. We've been in such a fantastic environment, really, for the last 15 years, since the last financial meltdown, that the window, for the most part, has been open. You want to go? Financials are they're in order. Let's go. Now it's okay. We have to stay current. That in case the window does occur, market's not open at all times anymore. There's huge valuation sensitivity. It is no longer a seller's market. It's a buyer's market. Meaning, if you want to sell and monetize your shares, you're going to have to come down to the buyers. So that's a change. But then two, because the window is not open all the time, find the window, be ready, and then strike. Well, nobody seemed to striking as of yet. And I think, again, just referring back to our other panelists' comments, we're in this quandary of uncertainty. Nobody knows. If you look at the economists from all the larger banks, some think we're closer to the end, and some think that the worst is yet to come. But I'm going to be the eternal optimist. And I've always looked at the glass half full. And for a little bit of last year, I would say I was looking definitely at the glass half empty. And it's kind of shifting back for a little bit. But that's not to say that we're where we need to be as of yet. I definitely think we're starting to get closer. With all the dark clouds, you start to see a little bit of a ray of hope. And what we've seen, specifically in this last quarter, and in just my opinion, we saw everybody kind of flush out for the most part. Let's kind of reset our earnings. Let's reset our valuation. Let's bring down expectations and growth, if we are going to grow in the future, to a realistic metric where investors that are sitting on the sideline or those that have already deployed capital gives you kind of hope and something to look forward to. So I do believe that we're closer to the end than we are at the beginning, but make no mistake about it, there will be choppiness along the way. So whether it's a quarter or 2 quarters, that's to be determined. I think everybody's going to be watching the next Fed announcement. That'll be in the next 2 months to see if it's going to be 25 basis points. Are we holding fast for now? Is there going to be in the future rate cuts? What we don't know is what we don't know. And so time will have to play out, and then we'll see when the time gets here. But again, from a positive standpoint, I'm okay with the valuation reset. Having corporates stay private, 50, 60, 70, 80, 90, $100 billion valuations, if you're invested thoroughly in the private marketplace, when you flip to going public, who is left to invest outside of retail? And not that retail can invest, but they're not going to stimulate and they're not going to stabilize like a true institution can. So I'm okay with this reset. You can never go straight up, a mountain. You got little peaks and valleys along the way. You have the China reopening. Take it for what it's worth. They're a huge consumer of goods. And I think that's also very important to know. Inflation, it's kind of teetered out for the most part. So we have some optimism there. The Fed, I think that's the uncertainty. What will they do? What won't they do? SVB, as much of a negative it is, it kind of at least seems, in my opinion, fast forwarded the pace, at least the Fed to be finished. And so from a standpoint of where are we going to be, look, I think you'll see some larger deals come. You could see one come before the end of the first half of the year. I think you'll see a few in the back half of the year, specifically Q4. I think you'll see larger sponsor deals that will come. They've been sitting on assets for a longer period of time. You can no longer flip from one sponsor to another sponsor because the cost of capital is no longer zero. But they're also going to have to be willing to take a haircut on valuation, which was previously referenced. And also that may mean that they may do larger offerings up front at a lower valuation. But you're going to start to see the stimulation of the economy as a whole. I'm pretty bullish and excited about 2024, whether that's going to be the second quarter. I hope it starts at the first. But again, it's not all doom and gloom. I think once we go down, there's always an opportunity to go back up. We've seen this playbook before, albeit it's painful as we kind of go through it. But again, I would say from an optimistic standpoint, we're getting where we need to be. Just a little bit more pain to go through. And hopefully we're coming back here on the next quarterly update and we'll have some positive news to share. So that's my standpoint, Sam. Back to you.
Jay, thank you so much. Well, gentlemen, thank you for sharing some opening comments here. Appreciate it. I have plenty of questions to go through. I know you hit a lot of them kind of obliquely here. Maybe we start on the banking fallout situation, meltdown, Bankageddon, whatever you want to call it. So what I'm curious about, are some of the actions we could realistically, take to prevent something, like this happening again. I mean, I think there's a good George Bush quote here. I'm sure every fool me once, can't get fooled again type of thing. So, what does that realistically look like? There's a lot of talk about the FDIC raising the 250. I think that's interesting, or at least maybe pegging it to inflation. What I think was one of the best critiques I heard against just kind of a laissez-faire approach was that, there are folks that are managing cash at these businesses that trust these deposits, possibly more than they should. But on the other hand, you have Jay Powell going in front of Congress a few days before the fallout saying, the banking system is strong, and do you expect, all these companies to have a better sense of the landscape than Jay? And I think Yellen was saying very similar stuff right at the same time. And then I think one of the most hilarious pieces of all this was Senator Barney Frank, sitting on the board, from Dodd-Frank, legend, sitting on the board of Signature Bank, and it falling apart right after the regulators give it the nod. So, I tee all that up to say it's a very interesting situation. I'm curious if anybody has any ideas of things that you've heard or see out there that, can prevent some of the fragility that we're seeing out there. One of the things I think is interesting, just to tee up a potential idea here, is there's, as a former bank auditor, I'm sure a lot of you are familiar also with the difference between the available for sale and held to maturity, balance sheet treatment. And there's a lot of hidden, markdowns because they just say, we plan to hold these to maturity. But when you start getting crunched, that needs to be, marked to market as they progress into available for sale. Is there reason to just mark everything to market on a quarterly basis the same way, a Gene would when he's running funds? So I'll tee that up. Maybe we can just go through in order. Sandy, you want to kick us off?
Sure. I'll just make a few comments. The first one probably very unpopular, but I think that a lot of the solution to banking is contingent convertible debt, and I get that everyone hates it. Contingent convertible debt that ultimately gets converted at unfavorable terms when your equity drops, I think is the solution. I think it's what most nonpartisan economists will tell you. I think it's basically forcing banks to pay for their own insurance. And as I always say, banks believe in markets unless they have to pay for their own insurance. And so I think that's certainly the best solution. I would say that there's a lot of talk about SVB and the fact that the maturity transformation they went through with borrowing, they had short-term deposits and they invested long-term, and certainly their duration mismatch was huge. But I would just say that's what banks do. Banks are involved in the business of maturity transformation. They take your deposits and they loan them to me so I can buy a house. And
Thank God.
and so the reality is that really these banks operate on trust, and any time really virtually any bank that had a run on it would fail. The question is, why do some banks have a run? And certainly with when you have 94% uninsured deposits, you're going to have and you have these unrealized losses that would wipe out your equity. You're susceptible to a run. But I would just say that the couple things. I mean, I guess just one last thing, and that is when you think about FDIC insurance, I would just say that the large banks have that insurance, right? That yes, we say it's 250, but we know that ultimately I can put my money in JP Morgan, and there is no chance with the systemic risk that they would be allowed to fail. And so ultimately, what you see are that these smaller banks in this way are operating at a disadvantage. And I think that's contrary to what we think of, in our system of wanting to, sort of give some incentive and some advantage to the smaller bank. And certainly they're less regulated, and that's their advantage. But at the end of the day, the big banks have insurance already, and the small banks don't. And as I think you were implying, I don't think we want depositors to have moral hazard. I don't look at a depositor as a capital provider who is thinking, oh, is this a good investment or not? We want stability of value. And so I'm not bothered by the depositors being bailed out. If you look at history, basically, people who are uninsured when banks failed, the vast majority of them gotten their money back, but those that haven't, it's like 90 cents on the dollar they get back. And I think you could make an argument that if you held these SVB's portfolio to maturity, the losses would be minimal. And so, regardless of the fact that the FDIC, took a $20 billion hit on this. So, anyway, those are my thoughts. But as unpopular as it is, I would just sort of push the contingent convertible debt as the best solution. Because if you have equity to absorb losses, then ultimately the likelihood of runs is much less. So.
Yeah, I think that's less radical than my nominal GDP targeting, friend. So I think you're in good hands. Well, Jay, I think your friend Jamie Dimon may have made out like probably the best bandit out of this whole entire situation. Probably, it seems like every dollar that goes from SEB ends up at JP Morgan. So, but quickly, Gene, you talked a little bit about Yellen going from kind of talking down the money market funds, maybe as a way to kind of ensure deposit dollars didn't wind up there. Are you seeing a lot of folks in that world, actually make the move and go into, cash type ETFs, product money market funds like that? I mean, they certainly seem to be a lot safer than deposits in a lot of sense.
Yeah, I mean, I would say three things, and I agree a lot with what Sandy and had said. I think the biggest thing that has come out of the SVB thing, I try to look for other angles than the strict obvious ones that usually the financial press covers. one of the things that I know for sure that I'm seeing among portfolio companies, for example, I don't know if you saw the list that was on LinkedIn of companies like Roku and some others that had tens of millions of dollars in SVB. I think one of the other bad actor behaviors that I can guarantee you is being fixed, if nothing else, by the venture capitalists who back these companies and their other shareholders. The office of the CFO has got to do a better job of cash management. You don't stick $40 million in a single bank. I wouldn't even put $40 million in J.P. Morgan. It's just the concept of diversity. Further, there is the ability. There's all sorts of computer programs and treasury management kits that allow you to break up money into 250K chunks per account registration. So, and that's assuming you really do want money in banks, which to me is odd because the banks generally, all you got to do is walk down the street of your local city or town and look at the CD rates. I mean, they're way below what even a money market fund, a treasury money market fund, is yielding. So, I think there probably is going to be much more sophisticated and careful treasury management by companies. That's one thing. And then the other thing that is mystifying, and it'll be interesting to see what the Fed report says about this, if indeed, there were triple the number of risk committee meetings going on at SVB, and if indeed, some of the early things we've heard, if indeed, the Fed was issuing so-called citations to SVB, the question has to be, how is it to be aware that you had a potential disaster with the duration mismatch? Why weren't more steps taken to hedge that risk or to ameliorate it in other ways? That's a pretty big mystery to me, and I do think that's and Chairman Powell, to his credit, I think said it's one thing to have regulations, but it's another thing to figure out how you make sure a certain behavior is followed to fix the situation. This situation was percolating for a long time. I mean, a long time in market days. So anyway, I think the good news is there's probably also going to be fewer small banks. I don't know what the average age of our audience is, but I never go to a physical branch. So this old idea of, I'm going to start a small bank in my town, and eventually one of the big banks is going to buy it because they want more branches. With electronic banking and everything else, I think it is time that there are fewer banks in this country. I don't want people to lose money, whether they're the equity holders, the bond holders, or the depositors. But in some ways, Mr. Market, I think, is probably saying it's time for fewer banks.
That's very interesting. Almost a Chomsky quote there. So Neil or Jay, anything else? If you were sitting in Jay's chair or there at the FDIC, is there anything you think that would be interesting to you to explore in terms of a regulatory structure that would prevent some of the things that we're seeing, some of the fragility we're seeing in the system?
Oh, well, I'll jump in first. So let me answer a slightly different question, and then I'll answer yours. I'll do a political move and answer the question I want to be asked. And that is the next shoe to drop in banking. And Sandy talked about this, I think, is commercial real estate.
Yeah.
I think office buildings are problematic. The hybrid work is causing companies to release at a much lower rate. They don't need as much space. So as the leases come out, they're 10-year leases, so they roll off slowly. But as they roll off, companies are not renewing. They're using this opportunity to move to higher grade buildings. And I think if you're in a middle tier office building, you've got a problem. And if rent rolls start declining, then you have a problem repaying your mortgage. And if you have a problem repaying your mortgage, then the smaller banks who do a lot of commercial real estate loans are going to have a problem. So I agree with what Gene said about consolidation in the banking industry. I think part of the consolidation is going to be this, and it's going to cause some losses. Now, in terms of the what can a depositor do? I mean, I think the solutions of creating multiple accounts, and there are firms that do that for you to go against the FDIC limit, makes sense. I think there should be higher FDIC limits. If the government is going to step in, if the FDIC is going to step in and create moral hazard by saying they'll cover any deposit, even if it's uninsured, then what's the point? And so they're just not charging for it, but they're providing it. So I think they should have higher limits. I think they should make them variable. I think they should allow banks to market that they have a $2 million FDIC limit and somebody else only has a 250,000, and they have to pay for that insurance. So I think that's a way to potentially solve it through market forces, and get to a much better position here.
Yeah. I mean, they're all great points. The only thing that I would say, and I thoroughly agree that we could see additional consolidation is, this is different than the last time, right? Than the financial meltdown. I would look towards, SVB. I mean, it's not like they were invested in bad instruments. They just didn't have the ability to hold to duration, right? In a perfect world, as quoted before, if you were able to hold and they were able to fight their way, the net loss would have been minimal, needless to say. But when you look at an SVB, you look at a Signature Bank, and you look at the assets, on the balance sheet, they're around 200 billion. When you look at the JP Morgans, the Bank of Americas, the really big banks, and I think to Neil's point, this is where the variables kind of make sense. They have balance sheets of close to $4 trillion. And we are not talking like apples and oranges here. Well, I guess we are talking apples and oranges. I mean, these are true separations of state. Look, the biggest thing is, regardless of what industry you operate in, whether it's the financial markets or whether you're in the industrials or the healthcare, once you lose the faith and confidence, of the ecosystem in itself, you're put in the penalty box. And it takes a long time to get it back. And so when you see that kind of run for the hills type of mentality, look, people are scared. You work your whole life, you save your money, you want to fund your retirement. You don't want to work till you're 80, right? You just, at some point in life, you want to take care of your kids, your grandkids. It doesn't matter, whatever it is. And to lose that faith and confidence in the system, that's a shockwave. And those shockwaves, that reverberates for a long period of time. Look, we'll regroup. I mean, on the positive side of the house, what I would say is people are willing to invest. There is a ton of dry powder that is out there just to kind of skew away from the overall banking industry. And let's just talk from a sponsored side of the house. It's whether or not it's going to be deployed to investments in which you're currently invested in that may need some further funding. Maybe they're underwater, maybe a dollar cost average in. But I think that's why we were seeing the capital markets, not so robust on the new issuances, because people are deploying capital to current investments. I would say, to Neil's point before on the converts, prior to SVB, we were starting to see secondaries. We were seeing blocks. We were seeing a lot of converts taking place, and some of those were trading at premiums and pricing at premiums. So again, this is the eternal optimist in me. We've been through this before. Look, the cards are always slightly changed. Maybe it's a different suit, than we've seen before. Maybe this time, instead of hearts, it's spades. But my point is, what goes down will go up. What goes up will go down. But we're in a better situation, in my opinion, than where we've been in the past. There's well capitalization. I think the risk exposure is not as robust. Again, do we see consolidation? Probably. Is that terrible? Probably not. But I think, again, the biggest thing, just for me, is you need the faith and confidence in the overall economic system here in the U.S., and that brings and exudes confidence And once we start to get that back and people are willing to take on more risk adverse assets or investments, then we really start to get this gravy train going back in the real direction. But again, to everybody's point, I think we have a little bit more pain to go through, and we will get there. We'll do it all together. But ultimately, just because where I sit, I am the eternal optimist, and I think there are good times ahead and bright skies coming. Just may have to go through a storm or two before we get there.
Yeah, well said. I take your point on the dry powder. I think is super interesting, right? And it's kind of been dry for a while, and I think you know I'm starting to to really draw a lot of this from the reaction to COVID. I was really shocked. I started looking at the monetary, like the M0, M1 measures. After we came out of COVID, the monetary and fiscal responses of that, I couldn't believe it. It was something like 4 or 5x the amount of dollars that are sitting in accounts in the world. I mean, I was shocked. And it's amazing. Obviously, the currency, is moves more slowly, but like the M1 measure, the amount of account dollars that you actually have, is now north of $20 trillion. So what I thought, and that obviously ends up in dry powder for investors. But one of the things I thought was really interesting in the middle of the pandemic, that was when I was still at Schwab, and if you have a low cost brokerage that also runs a bank, they were making money hand over fist as people go to cash. And then earn the net interest margin, which I thought was fascinating. And so when you start looking at a graph of in one that spikes 5 times what it's been, the inflation starts making a lot more sense. So I say all that to kind of convert from banking into more like the monetary inflation discussion. Obviously, you guys talked a little bit about this, but sitting as a individual, with money to spend now and in the future, how are you thinking about inflation and where you see it going? Obviously, we hope that we're able to crank rates down hard enough to where that starts ending, but we're starting to see cracks in the banking system, et cetera. So I'm curious if you guys could talk a little bit about inflation. Sandy, you want to kick that off? I know you have interesting views on inflation.
I just want to say Schwab. You probably realize this, Sam, but Schwab is at about roughly today. They're down about 50% from their 2023
That's right.
high,
That's right.
and so they're another one that has sort of this duration mismatch and they've recategorized a lot of their bonds from available for sale to held to maturity. As far as just the money supply issue, M1, M2, M3, the Fed, it was really sort of in the early 90s moved away from that and saw that it really wasn't tied, wasn't highly correlated to inflation. That's why you don't really hear the Fed speaking about it now. And you can look at a lot of people have talked about what's happened since the pandemic. But if you go back and you look after the financial crisis, you'll see that money supply increased greatly, but we had no inflation. But now we do have the inflation, so people are talking about it. And I think that in the past, like if you look at the monetary base, where you look at you include the reserves. You look, the difference is, does the money get into the hands of the consumers, where it did this time, as was mentioned earlier. I think that I think it might have been Neil who mentioned it, but it was the fact that you had all this fiscal stimulus. It's one thing for the Fed to do quantitative easing and buy bonds, and we see reserves in the system. If those reserves don't get loaned out, you don't have inflation. But when you have this fiscal stimulus that ultimately gets to the hands of the consumers, and in addition, even a bigger part was that people didn't spend money, right? We didn't go on any family trips or anything like that, so everyone has more cash. Then you've got money in people's hands, and you don't have the production of any more goods. I always tell my students that if we sent $1 million to every household, the price of Teslas would double or quadruple, because everyone wants a Tesla, and now they have the money, but we don't have any more Teslas. and so there's no more. And so I think that to me is the difference, is that it reached the hands of people. As far as inflation goes, I think it's really difficult. I think Powell likes to strip out housing because the data is so lagged, and that's really problematic. But I think that the question is, to me, largely is, are we going to go into a recession, and is the labor market going to loosen? And I think the evidence is that while the labor market's still tight, that it is loosening. And I think it's not just the JOLTS report yesterday, but I do think when you start to see that those wage premiums for job switchers versus people who stay come down, that tells you something, right? It usually actually reverses in a recession. So when we're headed in that direction, I think that's a really interesting clue. The reason job switchers don't do well, obviously, in a recession is they take less. They've been fired, and they take less to take another job. I think when you look at housing, you look at rent, you look at people's ability to pay, you look at the fact that real wages for last year really didn't keep up. And, real wages were negative, real wage growth was negative. I think it's going to be hard for people to continue to pay as excess savings run out. So, you're also seeing PPI come down a little. You're seeing, in the ISM report this week, we saw new orders, are way down relative to inventory. And so I think all those things speak to we're headed in the right direction. Who knows? There's always another shock. But you didn't see OPEC's movement change inflation expectations. And so, I think there are a lot of really positive signs that, expectations have sort of stayed anchored as they are. And so it's a long process. It doesn't just, snap back down to 2%. It's a long process, but it seems like we're headed in the right direction. And as was said earlier, it takes 6 to 18 months for Fed policy to work its way through the real economy. And so, I think we're headed in the right direction.
Yeah.
No, I got a thought on that, if you don't mind. And I appreciate all that Sandy says. Inflation scares the bejesus out of me. And here's why. Look, it may have tapered or tapering, and it's starting to slow down. But will we get back to the prices in which we were just at, 12 months, 18 months ago? And I can tell you, I have almost a 20-year-old who's a power lifter, and he eats like a racehorse. And when he goes to the store and he needs his protein and he needs his eggs and he needs his pasta, to see the prices, for a dozen eggs or 2 dozen eggs, whatever it is, or for milk or coffee creamer or cheese, it doesn't matter. Pick your commodity, it doesn't matter. Will it come down? Even as inflation has started to curb, the prices just have not turned over. And so I think from that standpoint itself, even on the labor market, we're seeing more automation. And so if there's more automation, we're starting to see certain jobs get eliminated. If certain jobs are getting eliminated, how are people going out and feeding their family? If they go to the food store and you just get this sticker shock, look, it's scary. I mean, to say the least. And, to Sandy's point, it's going to take time. But, here's a reason why, years back, and if you watch the movie The Founder, it was great. With McDonald's and what a cost of a hamburger was, again, years back. But how much is a hamburger now? You go to a diner in New Jersey. We got a lot of diners. And everybody always got like a hamburger deluxe. It used to be $4.95. Now it's $12.95. Could be $16.95. So my point is, even if we get back down to 2% inflation, God willing, it's sooner than later. It may take a little time, as I think we all agree. But will we see the adjustment on the sticker price? And I think that's also the unknown. Typically, what goes up doesn't come down. I think that's the only part that, for me, it just gives me a little bit of skepticism. Still going to be the eternal optimist. But when you just look at it, do eggs get back down to $1.99? I think there's a reason why Dollar General stopped selling them, right? They used to sell, a dozen eggs, I think, for $1.25, and they couldn't sell them for $3 because they're not $3 Generals, they're Dollar General. So who knows? I think that, we'll see what happens in the near term, but there is still, again, I just think there's a bunch of uncertainty to get us to where we need to be. That's all.
Yeah.
I'd like to say one thing though, Jay. I mean, everyone talks about the eggs, but the avian flu is a big issue there, and so
Okay.
you sort of have to,
I get it.
I think most things aren't going to come back down
Right.
But that's one that I have to believe. I hope we're, I've got a
Me
swimmer
too.
too, so as a kid, so I'm the same way as you.
Yeah, no, I hear you. It's and I that was just one of the examples, but and not every not every consumer good, whether it's staple or discretionary, is doubled or tripled, but just eggs as an example, because we are a very large consumer of them, and I agree with you on the flu standpoint. But even the cost of milk, coffee creamer, I've seen it, and so look, let's all be optimistic. Let's hope for brighter days ahead. I know, Neil, you had something to say as well.
Yeah, no, I think your point's well taken. The way inflation's measured is it's a change in price. It's not an absolute price level. So if something doubles in price, you have 100% inflation. If it then doesn't change in price after that, you have a 0% inflation. And politicians will pat themselves on the back that inflation's down to zero, but it's still doubled in price.
Right,
Year
right.
and so that's the thing. You have to look at over what time period and what are the real prices of it. And I think that's what you were getting at. So it is an important factor.
Yeah.
I guess we'll all be lucky to one day pay $100 for a hamburger. I think we want to live long enough for that. So we started touching on a little bit of the economy and AI throughout this. I think this is a good segue into maybe Gene's area, what he's seeing in the venture world. You touched a little bit on AI investments and a few bright areas in the venture world, even before kind of call it pre-revenue. What are you seeing out there as being hopefully the things that cause a lot of the disinflationary activity, the same way Amazon and Netflix and all the rest have done? What are you seeing out there that's most exciting to you that may change the economic landscape and hopefully play a similar role in the future?
Yeah, well, I'm not a techie per se, but I've seen some really interesting earlier stage companies. Everybody's talking about Chat GPT and the adoption of it with Microsoft and then Google's entry into that natural language AI for the consumer product. But the thing that has fascinated me, and it goes back a little bit to what people said in the .com era. It was the old railroad analogy. It's like don't buy the railroad, buy the steel companies or the picks and shovels or the whatever. In a .com era, it was buy Cisco because they have the routers, and people are going to need internet. Don't buy the stupid stuff like pets.com or whatever it was. So there's a little bit of that going on, and the specific area that is fascinating me, and I'm seeing some pretty enormous valuations, but there's some pretty I think there's some pretty good science behind it, and by that I mean financial science, in the sense that the value being assigned to data, which is ultimately what drives the whole AI process and its capability of learning. You need to have data. I may not have the numbers exactly right, but I heard a presentation recently where when Caesars, the Las Vegas hotel and gambling operation, went bankrupt, while they were not able, due to GAAP, to declare their data as an asset during the bankruptcy and the ultimate auction of some of the assets. Somebody bought the customer data of Caesars for $1 billion. And I guess the point that was made was, had that been declarable under GAAP as an asset, it might have bought more time for them. Since we're talking a lot about assets and liabilities here with banks, I guess my point about AI is I think I would encourage people to look a little deeper into what really goes into the whole AI ecosystem. And one of the big components is data. I ran across another company that is buying up from countries you wouldn't think of. Malaysia, Zambia, Egypt. They're buying hospital and patient data because there's a lot being talked about with AI as it relates to using it for diagnoses and outcome predictions, and even AI for scanning or reading X-rays or CT scans instead of humans, or at least doing the bulk of it and later intervention. But I think if there is one area, and Bill Gates has kind of been talking this way, if there is one area of technology I'm seeing where I think VCs are willing to say, yeah, the scalability of this and the early user adoption that we're seeing is so exponential that we're probably willing to pay up for this. And if the technology's there, even if they are pre-revenue, that's one example where I think you're going to see some sort of eye-popping valuations. Not all of them will end up being justified, but I think some of them will.
Yeah, that's really so. I think one of the the biggest arguments against rising wages has been stable productivity or even declining in America for a long time, since the 80s. So Sandy, do you think that this is something that starts to affect the calculus here as people have the equivalent of Bill Gates in their pocket as a co-pilot? Are the productivity gains there enough to really affect the labor market if you had to polish your crystal ball?
To me, I don't think we really know exactly how to measure productivity. I mean, it's tough. It's a tough thing to do to measure productivity with all the variable inputs of how things are changing. So I think that's really difficult. I mean, I think typically what we do is we look at productivity in hindsight and say, well, this is what we think has changed. But I think that the thing to think about with productivity is, when and how it really relates to me is, you look at 2% inflation as the target. You think of productivity gaining at 1.25% or that type of thing, and you get to 3.25%, and that's the wage inflation that you see that's consistent with 2% inflation. But as far as, and obviously we're above that. We're not that far above that, but we're above that. And I think that, to me, that's sort of all I think about productivity. I think all I read is, everything saying just how difficult it is, when you think about productivity to measure it as well as to predict it. And especially, I think the thing to remember is, as most of our productivity gains over time have been in producing goods, not in producing services. And so it's hard to make services more productive, and we're moving more and more to a service-based economy. And so, that's sort of my big picture on it. I think it's a really tough issue. Um,
Yeah, well, as we're probably got time for one more interesting one, and I know no one here works for the CIA, or at least I don't think that they do. I don't know, maybe Jay or Gene, I could see it possibly.
My ex-wife worked for the CIA.
See, there you go. That sounds like a good cover story. So there's obviously geopolitical to the likes of which we haven't seen for quite a while. You know, I think what's interesting to me is you all probably know that I think that nuclear weapons are probably the best thing that's ever happened to humanity since agriculture, probably. I think we've done the calculus on mutually assured destruction. Either we don't see a general nuclear exchange, which I think is likely, or we do, and either way, you don't have to worry about it. But I see very much kind of a chilling, like 1984 Orwellian kind of equilibrium where they have like the three big countries and they're doing play fights. how do you all think about this fairly lethal event in Ukraine and how that translates into what you're doing with your portfolios or advising clients? How does that trickle into your world?
I'll start. I mentioned that it does appear that possible black swan event, is on the minds of lots of institutional investors and including sovereign wealth funds. I don't think they see any value in talking about it a lot, but it strikes me that they view that as having a direct influence on what allocation they'll make to equities, particularly public equities. Because let's face it, if the thing I've worried the most about, and we saw this with these Russian jet pilots apparently accidentally, although it seemed like maybe it wasn't an accident, taking down that drone by running into its rear propeller. When you hear about tactical missiles being put into Belarus, on the border of Poland, I worry about just mistakes that could happen, because mistakes. I have a brother and a sister in the DoD business, and there are mistakes that happen with missiles. There can be all sorts of weird things that happen. So I worry that the more what's the right word? The more the battlefield sort of gets spread around and expanded, the greater the possibility of a black swan event. And let's face it, if that happens, it might snap back somewhat quickly if it's contained. But let's face it, global stock markets would sell off enormously. So I do think and this sort of goes to Sandy's point. I think there probably is an under allocation to stocks right now. For lots of reasons, but one of them I think is that some people are concerned about tail risk. That's what I'm seeing.
It's interesting. Bill Clinton was speaking at a conference and it made a little news because he admitted that maybe it was a mistake that we convinced Ukraine to get rid of their nuclear weapons in exchange for a treaty saying we would protect them and Russia would protect them. And it turns out neither will protect them. One will actually attack them. And so that they had nuclear weapons, or they had kept the nuclear weapons that they already had, there's a question of whether Russia would have invaded in the first place. And so when Russia does a saber rattling because Finland joined NATO, it's saber rattling. They're not intending to invade a NATO country. They're not intending to use nuclear weapons on a NATO country because they know the retaliation would be there. It's mutually assured destruction. And so there is something to be said for having weapons that do provide some protection.
And Jay, I'm sure you're talking to lots of institutions about how they're feeling. How often does something like this come up for them, and does it actually impact their strategies?
Sure. I mean, look, it's uncertainty is not a friend to the markets, right? It doesn't matter what asset class, one way or another. And so I think again, when you talk about the powder sitting on the sideline, it's why it's been built up and why it's there ready to deploy. But the whole situation in the Ukraine is obviously a net negative. I think the China reopening is a net positive, but then you have China working with Russia. I mean, I don't know. Where do you put that on the scale? So it's just kind of uncharted times. Do you have a rooster that's going to stick out their chest, and play like chicken? I don't know. It's what will Russia do? Hard to say. Do they really want to, move this war forward? I don't know. I'm not smart enough to kind of gauge that. The only thing that I can gauge is that, until we get this certainty here between these conflicts, and obviously NATO obviously intervening as well, it's just an overhang on the market, and it's an overhang on confidence. And so, how do you deploy capital into something where there's just truly an unknown? Anytime you invest, there's definitely risk capital, but the flip side is that if I'm an institution and I'm managing money, the only way I get paid is by investing and based on my return on those investments. So it's, again, no pun intended, but it's kind of like a chicken and the egg. But definitely the uncertainty in the overall, scope of how things are playing out, it's not a net positive. That's just my 2 cents.
Yeah, that's very helpful. So as
Can I
we,
just say,
yeah, go ahead,
can I
Sam.
just say, I think the one thing that scares me about the mutually assured destruction argument is, when you look at Putin, and if you told me that he knew he had 1 month to live,
Yeah.
do I think, oh, he thinks, oh, I've got 1 month to live, I'm going to write a letter to my kids? I worry about what he would do, that, he's got 1 month to sort of excite things. I'm not saying, that would happen. I'm just saying it does scare me. I don't know
Yeah.
what the safeguards are in Russia to stop, that he doesn't just have control of the button, but, a lot of people do what Putin tells them to do, or they end up in bad places in Russia. So, I mean, that's what scares me. But I would just say, as far as my portfolio, good times are bad. I think I find, lots of ways to lose money. So anyway.
I can second that. I do as well.
Yeah, you definitely have a scary finger on the button there, and I guess if our fears come to fruition, my sense is that it's no more worries. Obviously, in the last few minutes here, there's been some interesting choppiness in the public markets, a lot of dry powder, rising rates. One of the things we've seen, I think, is a big explosion in alternatives. It was at Yale, the first endowment to really get the ball rolling there, and we've seen that outperform all over the place. I think that continues, to this day. So I'll ask a question kind of generally how you all think about alternatives and interesting spots there, and then pair it with another question because we only have a few minutes left here. But you all, I think, 3 out of the 4 are investors here at Nth. I'll turn you into my investor relations team and ask, what was it that made you excited or interested in the world of venture studios, and particularly what we do here. So I'll kind of put those together. Do the round the horn. That might be our last one, but take it away, James. See, Neil, you want to kick us off?
Okay, sure. So in terms of alternatives, and I think Gene talked about this in terms of valuations, that they're not marked to market. I mean, clearly private companies as opposed to public companies, every second of the day, and Jay could attest to this, what the value is of that company. Private companies, you have no idea what they're worth. And at best, you try to benchmark them against public companies, which is terribly imprecise. And so I've had arguments with people who've told me that there is very little volatility in private companies, much less than there is public companies, because the value isn't changing all the time. And I said, well, if you don't look at the value of your stock portfolio but once a year, the value won't change that often. It'll only change once a year. And so it'll have much less volatility. And that's basically what they're doing. And so there is volatility in it. Now, I think to have a studio that's starting company is a total difference there, because you're not dealing with the valuation multiples that companies were afforded, where they were getting multiples of things like revenue. It reminds me of the 2000 boom when people were trading companies based on clicks, and how many people were clicking on that as a measure of some value or profitability or revenue or something from clicks. But yeah, never understood that. I don't understand how you can take a company with revenue and say, I'll pay a multiple of that revenue. Because if the company's losing money with marginal loss, every new product they create, it costs them $10,000 to create a product and they sell it for $1,000. Selling more of those is a bad thing. you're losing more money. And so, I don't understand that methodology. And I think we're finally getting back to having a little more value discipline in the markets where valuation does matter. And I think it's very painful to go through, but boy, it feels good when you're on the other side of it and companies are actually valued based on what they're actually able to achieve on a bottom line basis over time.
Yeah, and thank you, Neil and Sandy. I know the professor has to go to office hours, so I'll let you maybe go next. Go ahead, Sandy.
I don't really look that much at alternatives. So the interesting thing that I saw, and this came from David Swenson's book, was he was arguing that if you're not in the top 25% performance of private equity, you're underperforming on a risk-adjusted basis, the S&P 500. I also think what I tell my students, and Sam, I probably said when you were in the class a billion years ago, that I think if we meet back in 20 years and we compare the returns on private equity and including VC, I think we're gonna see the returns are gonna be much lower than they have been historically. There's just so much more competition bidding up the prices, and it seems impossible to me that we could do as well. But I think I think that everyone knows that you really want to, as they say, bet on the jockey in this case, and I think that's what people are betting on with you. They're betting on you, so there's a little pressure.
No pressure. Well, thankfully, there's a lot of jockeys. I can blame. So maybe Gene, you want to go next, sir?
Yeah, no. Great comments by Neil and Sandy. I think the good news is the slight pushback to what Sandy said. Venture capital, to me, has always been a wider dispersion of return asset class, at least compared to active management in public equity. And yeah, so there's definitely there ends up being a selection bias for the best companies, going to that same top 25% of returns that David Swenson talked about, for venture capitalists. But I think that with respect to Nth Venture, what I was attracted to is the ability to invest in some curated companies. I mean, it goes to Neil's point. The thing I always go to first when I'm looking at startup or even later stage company decks is what are the unit business economics? I mean, because anybody can throw an Excel spreadsheet with all sorts of numbers, revenue numbers and stuff, but if I don't know what the good or service or subscription, what its unit economics are in terms of profit and loss, it's pretty hard for me to get excited about any company. And the company that I've invested in through Nth Venture, I think, has that. I think also in a weird sort of way, Sam, Nth Venture's model now of launching sort of mini funds of curated companies with real entrepreneurs who you can talk to. While they may be pre-revenue, they're nonetheless being valued, at quite low entry points. And it's always been the same, right? Jay knows this. Everybody listening and on this panel, buy low, sell high. I mean, where you enter as a purchase price, has as much to do with your return as the exit price. So I think the Nth Venture model is pretty attractive. I think the hard work, and I know, Sam, you do this, is finding the entrepreneurs who get the revenue share model and who are willing to, work with, an incubator sort of scenario, like that. Not everybody is, but I think, to my earlier comments, it is really hard to raise private capital right now for raw startup companies. So I think in some ways the market may be coming to you.
That's great. Yeah. If you pay someone out of a profit pool, you'd be amazed how fast they get to revenue, I think has been our experience instead of the salary. So Jay, you want to bring us home, sir, on
Sure.
the topic of alts and, what got you involved here at M?
Yeah, and so just high level, it's been a pleasure, to be on the panel with everybody, and great to see you. And thanks for tuning in, everyone watching. Look, I'll take it from a little bit of a different angle on alts. We as the exchange, people think of Nasdaq as the Apples, the Amazons of the world, and we're just so much more than that. And believe it or not, the conversation around data, we are a huge compiler of data, and any type of data in which you get and have access to, you can monetize on. So that's one. Uh, our revenue is just from a bottom line. 50% is ARR. So when you think about how do you reoccur that revenue, data is ultimately going to be the key. And from the alt side of the house, look, we're going to be launching a custodial exchange for digital assets. And so whether it's going to be an equity, debt, or digital, it can be Bitcoin, Dogecoin, which kind of changed. I don't know, Elon did something in Dogecoin outside of my realm. Just want you guys to know, and gals. But so my point is they play a part in the ecosystem. It doesn't have to be a full part, but I think it's the evolution of the overall marketplace. So I think, look, from that standpoint, we'll see where it goes, and we'll see where it ends up. In regards to Nth, having the platform as an incubator and the talent, that you've been able to, to draw, and to the conversations and speaking with people, entrepreneurs that have been successful and really kind of rolling their sleeves up and to incubate, grow, and show success and real return on people's investments. I think that is just fantastic. And I think that's why it is a great vehicle and why we're continuing to see additional people look at the platform, look at the companies that are being spun out from the cohort. So for anybody watching, it's definitely great to learn more about, inquire about, but nothing more, nothing less. It's, look, markets evolve, things change, good times to come, maybe bad times first before good times, but ultimately you got to look with the sun will rise again, and it hasn't really kind of set as of yet. So maybe it goes up and down a little bit, but until we meet again, just keep on smiling.
All right. Thank you so much, Jay. Appreciate it. Everybody, it's been fantastic to get you here. And thank you so much for tuning in, folks. I think there was a quote from the CEO of Markel recently. He said, dance with who brung you and keep on dancing. So I think we'll be doing a lot of that, keeping on dancing here. So thank you again. All of Sandy, Neil, Gene, and Jay do interesting things out there in the markets. Thank you for the folks who are tuning in live, and we'll also be getting those recordings out. You can find them in their relevant places. But thank you, gentlemen, and appreciate it so much.